Hi, my name's Nigel Grant, and in today's video we're going to look at the presentation of liabilities when preparing a statement of financial position. I hope you'll find this video very useful.
Well, in order to understand the presentation of a liability, one first of all needs to understand the definition of a liability. According to IAS 1, a liability is defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of resources from the entity embodying economic benefits. Now that's quite a mouthful and quite hard to swallow, so let's see if we can break it down into three parts. The first point, there must be a present obligation. Something must have happened in order to give rise to that obligation. What do we mean by the term obligation? Well, simply something that we are duty bound to do. So for example, if we take out a loan, we are duty bound to pay back the loan. In order to have a present obligation, there must have been a past event. Something must have taken place in the past that has given rise to the obligation. For example, if one wants to take out a loan, one will have had to have signed a credit agreement. That signing of the credit agreement is the past event. As a result of having this obligation in existence, the third point is we're expecting that there should be a future outflow of resources embodying economic benefits. In simple terms, we're going to have to pay somebody at some point in the future. Well, now we know what a liability is, the next problem is trying to decide, should we present a liability as a current liability, non-current liability, or a mixture of the two? Well, IAS 1 will provide some assistance with regard to this matter. IAS 1 says that a liability should be presented as a current liability where it satisfies any of the following criteria. The first criterion, the obligation is expected to be settled in the entity's normal operating cycle. Well, what is the entity's normal operating cycle? The normal operating cycle for a manufacturer is a cycle of buying in the raw materials, manufacturing the goods, selling the goods, and receiving payment for those goods. So, if an obligation has arisen as a result of buying in raw materials, this obligation would be presented as a current liability. Second criterion, the obligation is due to be settled within 12 months after the reporting period end. If, for example, an obligation has arisen as a result of an event which is unrelated to the entity's normal operating cycle, and this is due to be settled within 12 months of the reporting entity's balance sheet date, this should be presented as a current liability. For example, a bank loan does not arise from the entity's normal operating cycle, but if any part of it is due for repayment within 12 months of the reporting period end, that part should be presented as a current liability. Third criterion, the entity does not have an unconditional right to defer settlement for at least 12 months after the reporting period end. This criterion is designed to cover situations where the reporting entity does not actually expect to settle the obligation within 12 months, but where the demand for settlement within 12 months is at the discretion of the lender and not the borrower. For example, the reporting entity may have a bank overdraft which it does not actually expect to settle within 12 months of the reporting period end. However, the overdraft would be presented as a current liability, as if the bank demands payment within that 12-month period, the reporting entity does not have an unconditional right to defer settlement for at least 12 months after the reporting period end. Remember, bank overdrafts are repayable on demand. Well, now that we've established what a current liability is, we can see that a non-current liability is simply any liability which does not satisfy the criteria to be defined as a current liability. In most cases, a non-current liability will simply be a liability where the obligation is to be settled after more than 12 months from the reporting period end. A further problem is that sometimes with loans, the obligation will be settled in installments over a number of accounting periods. In these situations, it may be that at a particular reporting period end, part of the obligation will be due to be settled within 12 months of the reporting period end. In this case, that part of the obligation should be presented as a current liability. The remainder of the obligation, which will be settled after 12 months from the reporting period end, will be presented as a non-current liability. So let's have a look at an illustrative example to try and consolidate the points made earlier. Bob took out a bank loan for his business for £24,000 on the 1st of January 20x1. All interest accrued is paid on the last day of the reporting period. Bob will also pay off the principal over 3 years in 3 equal instalments of £8,000 each, paid on the 1st of January 20x2, 20x3 and 20x4. Bob's reporting period date is the 31st of December annually. Right, the illustration would like us to state what amounts, if any, should be shown as non-current or current on the balance sheet extracts. What I'm going to do is to identify the relevant amounts that should be reported as either current or non-current in the empty boxes provided year by year. Right, so at the 31st of December 20x1, the total liability must be £24,000 as no payments are due to be made until the 1st of January x2. In order to decide the breakdown, we need to look at the current liability first of all. We can see from the question that in any 12-month period an instalment of £8,000 will be made. So at any reporting date the current liability must be £8,000. If the total liability at the 31st of December x1 is £24,000 and the part which will be settled within 12 months is £8,000, the remainder to be settled more than 12 months from the reporting period end must be £16,000. Moving on to 31st of December 20x2, if we have paid £8,000 on the 1st of January 2002, then the total liability will now have come down to £16,000. The same logic applies. Within the next 12 months, i.e. between the 1st of January 2003 and the 31st of December 2003, we are due to make a repayment of £8,000. This therefore is the current liability at the 31st of December 20x2. If the total obligation is £16,000 and we are due to settle £8,000 within 12 months of the 31st of December x2, the remainder £8,000 is our non-current liability. Finally, at the 31st of December x3, the total liability will now be £8,000. All of this is due to be settled within the next 12 months, in fact the very next day, and so the current liability will be £8,000. As nothing will be settled after the 31st of December x4, there is a zero non-current liability. This slide illustrates the previous example by making use of a timeline to show how the liability changes over a 3-year period. Okay, at the 1st of January 20x1, the total debt is £24,000. No payment will be made by the 31st of December 20x1, So at the 31st of December 20x1, the total liability is still £24,000. Looking into the future, we can identify that £8,000 will be paid within 2002, i.e. within the next 12 months. So the current liability is £8,000 at the 31st of December x1. The non-current portion is simply the remainder, £16,000. Having made a payment on the 1st of January 20x2, the total liability at the 31st of December x2 will have come down to £16,000. Again, look into the future and try and figure out how much is going to be paid within the next 12 months, in this example, within 2003, and again the answer is 8,000. So at the 31st of December, £8,000 is your current liability. The non-current portion must also be £8,000, as it is simply the remainder of the original obligation. Having made a payment on the 1st of January 20x3 of £8,000, by the time we get to the 31st of December 20x3, the total liability has now come down to £8,000. Looking into the future, a final payment of £8,000 will be made on the 1st of January x4, so the current liability at the 31st of December 20x3 is £8,000, and the remainder is 0, so we have no non-current liability. Well, you've listened to me long enough, so now it's your turn. Have a go at this next activity and see how you get on. Please feel free to stop the video to give yourself time to think about what you're trying to do. Now let's have a look at the solution. The main point to bear in mind is that at each reporting period end, i.e. each balance sheet date, identify the total liability. Think about the next 12 months. Ask yourself how much of that liability is due to be settled within the next 12 months. That's the current portion of the total liability. The non-current portion will simply be the remainder. Right, following the numbers appearing, the timeline will also appear so that you can have an alternative view of the solution.
Okay, so to summarize, remember that in order to be able to understand the presentation of a liability, you need to understand and remember the definition of a liability. So remember, present, past, future. Present obligation, past event, and a future outflow of economic benefits. I hope you found this video useful and enjoyable, and look forward to more in the future.